In this video, we're going to explore what investment is, why and how we invest, and the associated risks. What do we mean by an investment? An investment is an asset or item acquired with the goal of generating income or growth. In an economic sense, an investment is the purchase of goods that are not consumed today but are used in the future to create wealth. Therefore, when we invest into assets. In simple terms, there are 6 asset types. Cash, fixed interest, also known as government and corporate bonds, property, shares or equity, commodities, and alternatives. Let's look at each in turn. Cash is general savings held in a bank or building society. The benefit of cash is that it's secure, subject of course to the financial strength of the institution. Another benefit is you have immediate access to cash when you need it. However, low returns or even negative returns can be experienced in relation to inflation. Governments, other public bodies, such as local authorities, and companies will often raise money by issuing long-term bonds that promise to pay an income. Bond values can fluctuate depending on current interest rates and supply and demand. The benefits of investing in bonds are low volatility, liquidity, and they aim to earn higher interest than cash. The risks include interest rate risk and financial assurance from the loanee. Here we're referring to residential or commercial property. The benefits of investing in property are rental income and capital appreciation. The downfalls, however, include illiquidity and the capital value depreciating. Also, upkeep costs and the risk of no rent if the property is unoccupied. Shares, also known as equities, represent fractions of a company. If you own a share, you own part of a company and a proportion of the company's value. Returns are based upon profits of that company. However, they can be positive or negative depending on how well the company is performing. Shares can be traded, with the share value dependent on performance. The benefits are capital growth and dividend income, but there are downsides. These include capital risk, volatility risk, currency risk, and timing risk. Commodities are raw materials, for example gold, oil, or wheat. They can be very volatile because returns fluctuate heavily based on supply and demand. From a positive point of view, commodities can offer high levels of profit. Conversely, losses can be made just as quickly. Alternatives are investment structures that derive returns differently to what we have already presented, for example infrastructure, hedge funds, and structured products. You can have direct ownership, for example a share or a whole building, or, more commonly, you can invest into regulated collective investment schemes such as funds, unit trusts, investment trusts, open-ended investment companies, or exchange-traded funds. For many of us, it's difficult to buy lots of different shares, property, etc. unless you have a large amount of money to buy them. A collective allows you to pool money together with other investors so that you can buy a stake in these assets. The main benefit of investing in funds is that it allows you to pool your money with other investors to take advantage of investment opportunities more easily than if you bought the individual assets yourself. Using funds helps you to diversify your holdings, not just in the type and number of assets, but by sector and location. We do this to target returns, minimise losses, and manage risk. Contact us today to find out more.